we get to take 99, then you got a problem.
Here we go.
Welcome to Giving You Keys to Homeownership. I'm your host, Kimberly Watson Johnson, and today we have one of the best local FHA lenders in the state. Welcome Craig Hodges with Citywide Home Loans. How you doing, Craig?
Doing wonderful today. How are you doing?
I'm doing quite well. Tell me a little bit about yourself and about what you do. Well, tell the audience a little bit about yourself and what you do.
Like she said, my name is Craig Hodges. I work with Citywide Home Loans. Been in the mortgage industry over 25 years, and I just like to help people with their mortgage financing and make those dreams come true.
There we go. Sounds good. Sounds good. So today we want to talk a little bit about FHA, seeing that's your baby.
Correct.
All right. First of all, what is FHA?
Well, FHA stands for Federal Housing Administration, and it's basically a loan that's insured by the government. It's backed by the government and insured by the Federal Housing Administration. Basically, there are various types of loans. For example, FHA is one of them, conventional, VA, which is Veterans Administration, and USDA. But today I'm going to expound upon FHA. First of all, FHA loans are basically simple and very secured. Okay, like I mentioned, they're backed by the government. So right then and there, they're secure. With FHA loans, you have different property eligibilities. So for example, a single family home can qualify for FHA, a manufactured home can qualify for FHA, and also up to a 4-unit can qualify for FHA. When I start speaking in reference to FHA, there are some things I like my clients or those that I'm consulting to consider. One of the major things is basically from the top is basically credit scores. FHA credit scores, you could range as low as 500 all the way up to 850, which is the highest. So when I'm talking about credit scores, your credit scores range from 350, 300 to 850. But of course, you want to be more on the higher end as far as credit scores are concerned. Well, FHA, you can go as low as 500 on the FHA credit score, but that is going to require at least 10% down. FHA, the minimum required investment is 3.5% down of the purchase price. So, for example, if you have a purchase price of $100,000, 3.5% down, that's $3,500. Well, FHA requires you to have in some type of liquid account, asset account, which is called the MRI, the minimum statutory investment. You have to have that shown in an account for FHA in order to qualify.
Wait a minute, I got one question. So my question is this. That money I got upstairs in my mattress, I can use that, right?
Not necessarily true. Okay.
Because you'd be surprised how many people they'll call, they'll get started, and then come to find out that money been in a safe because they don't trust banks. Okay. So please expound on that so they can understand, because that's one question that kills me all the time.
Absolutely. So, good point. It cannot be mattress money, okay? The money has to be sourced and seasoned. Sourced meaning it needs to be in a financial institution such as a bank or credit union, a liquid asset. It has to be sitting in the account for at least 60 days. So the underwriters, and those are the individuals that sit in the office and they look at your different types of income, your W-2s, your paycheck stubs, your tax returns. They're going to give the final stamp of approval. Well, that money has to be sitting in the account for at least 60 days. And you need to provide at least 2-month bank statements to the underwriter. And I'm going to kind of discuss that a little bit later on as well.
Okay. Sorry. I just had to throw that in there because I know. Yeah. Ooh, I know. Yeah. All right. Go ahead.
Okay. So credit scores. Let's get back to credit scores. Like I said, you go as low as 500, but I can go 580 is with 3.5% down. So like I said, 500 is 10% down. But if you have a 580, the minimum is 3.5% down, 580 and higher. When you're dealing with credit scores, there's some things that we look at, okay? There's 3 things that really affect your credit, and I think this is very important for you to know. The first and most obvious is on-time payments. So you want to make sure you make your payments on time, okay? The next thing is your credit to balance limits on revolving credit. So when I say revolving credit, I'm referring to basically just credit cards. Not installment loans, not student loans, just simply credit cards. And this is a good rule of thumb for you all to remember, the 30% rule. So on credit cards, you take your limit on your credit card, you multiply it times 30%. You want to keep your balance at that or lower. So for example, if you have a credit card with a $1,000 limit, take it times 30%, that's $300. You want to make sure your balance is at that or lower.
Okay.
That's going to help increase your scores. But usually what I tell my clients, let's get it down to the 10% rule to really increase your credit scores.
Okay, that's when it looks good. That's when
Absolutely.
it looks real good.
But a lot of individuals have high balances along with the high limits, and if you need to get it down to stop the bleeding, let's get it to 30%. Okay? So basically and the last thing is be careful when you close out credit cards. That can actually impact your score as well if you close a credit card out. There's a certain equation you want to use if you're going to close a credit card out, and I kind of want to keep moving on. But like I did the individual 30% rule, whether you want to close a credit card out, you want to do the overall 30% rule. So you add up all of your limits, you multiply that times 30%, add up all of your balances, and you want all of your balances to be lower than that.
Oh, okay.
Because if you have a credit card with a $5,000 limit and no balance, and all your other credit cards are maxed out, you close that credit card out with $5,000 with no balance, that hurts your overall 30% rule.
Oh, okay.
Okay?
Never knew that.
Yes.
You learn something new every day.
Yeah. So basically that's all I'm going to go over as far as credit is concerned. The next thing you want to do basically is basically around derogatory. So for example, with FHA, if you have a bankruptcy, a Chapter 7 or 13, this is very important. It has to be discharged for at least 2 years before you can enter into a mortgage.
Okay. Now, when you say discharge, that's when they go in front of the judge or when they file, because people get that confused. They're like, well, I did my bankruptcy in 2020, but it wasn't discharged until later in 2020.
Correct.
So that's something they need to understand. That.
So the 2 year starts once it's discharged.
Okay.
Once it's fully completed.
Okay.
Not when it's filed.
Okay.
And it's from the discharge date. You can enter into a mortgage 2 years after the discharge date. Okay. That's for like a Chapter 13 and a Chapter 7.
Okay.
Also, if you had a previous foreclosure on a property, there's a 3 year waiting requirement for a foreclosure.
Only 3 years?
3 years.
Oh.
For FHA.
Oh, okay.
So you can enter into a mortgage after 3 years.
I'm going to stay in my lane because I was telling people 7 years.
Nope, it's 3 years.
Okay, so we're going to stay over here on the real estate side.
Okay.
Go ahead, Craig.
Okay. So, with my clients, what I like to do, I don't like to just pull my client's credit report. I kind of want to have them basically, if they don't know their scores, you can go to creditkarma.com, and that pulls your TransUnion and Equifax score. And then you can go to Experian.com to pull your Experian score. So I don't like to get in the habit of just pulling my client's credit report, and do their credit a disservice. If you don't know your credit scores, kind of pull those or try to get those scores through a soft pull before a lender pulls your credit score. And I think that's very, very important because you want to kind of go in, and by myself being a lender, I want as much information as possible because I want to help you make the most informed decision.
Okay, I like that.
Okay?
I like that.
So that's something that's very important for you all to do. I'm kind of old school. I like to do everything on pen and paper, calculate what's called your debt to income ratio. And some of you all might not know what that means, but I'll kind of go over that later on.
Okay.
So the next thing I'm going to talk about as far as like credit, we went over that. And by the way, with underwriters, we go by the middle score, the median. So out of the 3 scores, TransUnion, Equifax, and Experian, we take the score that's in the very middle, the median score. We don't do an average, we just take the median score. Okay. Let me go, so when you qualify for FHA, that's credit score is number 1, and then we want to kind of look at your income, okay? So these are some of the things you want to have ready to provide with your lender. Number 1 is your W-2s, okay? So if you're a W-2 employee, you want to have at least 2 years W-2s. FHA requires 2 years. So if you're coming to see me right now, we need your 2020 and 2021 W-2s. The next thing is we need 1 month recent paycheck stubs, okay? Because we got to calculate your income to make sure you have the ATR, the ability to repay this debt back. So please don't get frustrated if you think your lender's asking for too much documentation. Remember, the investors, they're concerned. They want to make sure you have the ability to repay the debt back. Okay. If you're self-employed, we need 2 years tax returns. So when you think of FHA, just remember, we're referring to 2 years basically on W-2s, tax returns, 1099s if you're self-employed. And if you have a business, we need all schedules, personal and business, all schedules. So don't leave out your 1099s or your K-1s. Don't leave out anything. Please provide the lender with as much information as possible. It's going to make our jobs a lot easier. Okay? And also, we need to show that you have the proof of funds to close and for your down payment. Now, if you all were listening, remember what I said. FHA requires what? The minimum down payment of 3.5%.
Yes.
And if your score is under 580, it goes down to 500. What did I say?
10%.
Great job. So she's listening. She's listening. Okay, I hope you all are as well. So that's the next thing. Bank statements, you want to have at least 2 months bank statements, all pages. I have some clients that they leave out the page 5 of 5 because it was blank. There was nothing on there. Investors, they need to see all pages, even page 5 of 5 if it's blank. Also, you can use your retirement for your down payment and closing costs. So if you have a retirement out there, please provide your most recent quarterly statement.
Retirement.
401k.
Okay.
Your 401k statement.
Okay.
Provide your most recent quarterly statement, all pages. So like I said, if page 5 of 5 is blank, all pages. And also, you want to provide the terms and conditions of withdrawing that 401k.
Oh, okay.
Because we need to see, are there any penalties or what have you. So with 401k, the most we can use for FHA is 60%. We can't use the whole 100% of the vested amount. We use 60%. Okay. That's the most we're able to utilize. Okay. And that's basically it. They need we need a copy of your driver's license and so forth. But those are the main things I want to, talk about. Income and assets. Those are very, very important. Now, depending on what state you're in or what county you're in, there's different types of loan limits. A good resource to use when you're thinking about FHA is www.hud.gov. That's HUD as in David.gov. That's a good resource for you to use. So depending on what area you're looking to purchase in, different states have different loan limits, FHA loan limits. So if you go like where we are right now is $420,680. Well, if you're trying to buy a house for $500,000 with 3.5% down, you won't qualify for FHA. For the simple fact you're over that loan limit. So make sure if you're thinking about going FHA, please be careful and look at your loan limit, okay? You can put more down to get to that loan limit, but 3.5% of $500,000 is not going to get you that loan limit.
Okay, gotcha.
So it's very, be very important. It's very information to remember, good information. Also, with FHA, you might hear something called PMI, private mortgage insurance, but with FHA, it's called MIP, mortgage insurance premium. You might be asking, what is PMI? Well, PMI is an insurance that protects the lender if you default on your loan. So I tell my clients, when you hear the term insurance, what does insurance mean? To protect. Car insurance protects you from, auto accident or theft. Homeowners insurance protects you if your dwelling was to burn down. So that's what PMI does. It's an additional cost, including your mortgage payment, that protects the lender if you were to default on your loan or your house were to go into foreclosure.
Okay. I don't want none of that.
No, you don't want that.
And what if can I get rid of it?
You can get rid of PMI now on a 30-year fix. PMI is for 30 years for the life of the loan unless you refinance to a conventional loan.
Oh.
So with the conventional loan, if you put 20% down, you don't have PMI.
Okay.
You can get rid of PMI on the FHA loan. A lot of people don't know this. On the 30-year fix, if you put 10% down, that's the only way you can get out of PMI. And usually it takes approximately like 11 years to get out of PMI.
They're going to get that money one way or another.
They're going to get their money. They're going to get that money one way or the other.
That money.
So, you know, and if you go conventional financing, which I'm not going to get into, if you put 20% down, you automatically don't have PMI.
Okay. All right.
And so your mortgage payments, for some of you all that don't know, your mortgage payment is comprised of 4 things, okay? Your principal and interest payment, that's the principal and interest you're paying back on the loan. Your property taxes, you got to pay your monthly property taxes, which a lot of us don't like to pay. Your private mortgage insurance, and that's what I just discussed. And your homeowner's insurance. Those are the 4 things that's going to make up your total mortgage payment. So when you're sitting down with your lender, they're going to go over your principal and interest, 1, homeowner's insurance, private mortgage insurance, and property taxes. Those are the 4 things that make up your mortgage payment with FHA. Okay. The next thing I like to talk about is basically an appraisal and a home inspection, okay? So, you know, if you have a good real estate agent like Kimberly,
Thank you.
she'll discuss all those things with you, but I encourage everyone to get a home inspection, especially with FHA, because FHA, mostly when you're doing finance, you have to have an appraisal done on your property, unless you get an appraisal waiver, which those don't happen really on FHA loans, only on conventional loans. But you basically you got to have an appraisal done on the property. And you might ask, what is an appraisal? An appraisal is going to determine the value of your property, okay? Because you don't want to buy a property going in upside down. So, for example, I could sell you my property. I could say my property is worth $400,000.
Okay.
An appraiser comes out there and appraises for $300,000. If you don't do an appraisal on that property, guess what? You're going in upside down.
Oh, yeah.
Yeah. So let's go back to home inspection. A home inspection is going to determine the soundness of the property. They're going to make sure there's no electrical, plumbing, foundation issues. I always encourage to get a home inspection, but lenders, we don't require a home inspection.
Right.
We only require an appraisal to determine the value. The reason, especially for FHA, is good to get a home inspection is because with FHA, the appraisal criteria is sort of strict. They're going to look at everything with a fine-tooth comb. They're going to look to make sure there's no chipped or peeling paint, the wall plates are on, cracks in the foundation. They're going to really look at everything, okay? So do your due diligence up front and do a home inspection, and then you might want to go to HUD.gov or Google what do FHA appraisal, what are the requirements, what does the FHA appraisal look for when financing for FHA, and that's going to help you out a lot when you get that home inspection report back. So another thing I wanted to talk about, and I kind of wanted to go over this as far as income, is job history, and this is very important. FHA likes to see you have a 2-year job history, okay? Over a 2-year period, they don't like for you to have, you won't qualify for more than, if you have more than 3 jobs in a given 2-year period.
Oh.
Yeah. I mean, you could qualify if the underwriter downgrades you to a manual underwriter, but you kind of want to be consistent with your job history over 2 years.
Okay.
Yep.
That's another thing. I had no idea.
And most people think that basically you have to be in the same career, the same position. Mm-hmm. No, you could switch jobs, you could switch careers, but you want to be, you want to stay consistent. You don't want to do more than 3 jobs in 2 years.
Okay.
Yeah.
Okay.
Yeah. So that's something else I want to mention, as well as this. If you're buying a property for FHA, have you heard the term flipping? I know you have.
Oh yeah, I've heard of flipping.
Okay. So there's something called this flipping, okay, that basically, if Kim's your realtor and she finds you a property and the listing agent, and she writes an offer on the property, and it's very important to find out when that property was sold, when that deed was recorded. Because if it was recorded if you try to sell that property within 90 days of the deed being recorded, they won't qualify for FHA financing. It has to be on the 91st day from the deed being recorded before you can enter into FHA financing. After 91 days, if your buyer decides to proceed forward, it's going to require 2 appraisals.
2 appraisals.
Between 91 and 180 days. And after 6 months, it's only 1 appraisal. But after the 91st day to the 180th day, it's going to require 2 appraisals.
Okay. Yeah. All right. So I want to know, can you have more than one FHA loan?
You can't have more than one FHA loan. The reason being, say for example, if you already have an FHA loan right now, and you decide that you need to downsize, you have children, and your house is just too large, you want to downsize, and you're moving like more than 100 miles, 200 miles away, you can qualify for another FHA loan from this departing residence. You can. It's not frowned upon. It's just that you're moving on and the house is too large and you want to kind of downsize, but you can. But one thing you cannot have, you can't buy an FHA loan for an investment property, a second home. It only could be a primary residence for FHA.
Okay, cool.
Yeah.
Now, is FHA only for first-time home buyers?
No, FHA is for first-time home buyers and non-first-time home buyers.
Okay, so FHA is for everybody.
Well, I wouldn't say it's for everybody. I wouldn't say that. I mean, if you have very low credit scores,
close enough, it's for everybody.
Yeah, that's not for everybody. But yeah, but yeah, to answer your question, yeah, first-time home buyers and non-first-time home buyers.
Okay.
And it's a big misconception out there. They say the FHA is only for first-time home buyers.
Right.
Well, it isn't.
Okay.
Yeah.
Okay. Now, with FHA, are there additional costs?
Additional costs as far as?
Just any type of additional costs. You know how that's one of the biggest questions I get when I talk to people about a FHA, you know, that maybe they should consider, they can't qualify conventional, maybe they should consider FHA, and they're like, doesn't that loan have extra costs? Don't ask me in regards to extra costs. I mean, I would think that all loans tend to have, depending on the loan, they all fall under the same. Only,
Correct.
no,
Yeah,
there is no extra
the closing costs. I mean, there's cost involved as far as closing costs.
Right, but there's no extra. There's not, just because you got FHA loan, they don't add on extra things. That's what I'm.
No, they don't. No.
Okay, that's kind of where I was going with that. Just because it's FHA, they don't just tack on other stuff. Okay, now, are there different requirements by the lender for an FHA as opposed to conventional? Are there different requirements?
Yeah, there are different requirements. Sort of some of the items I've already discussed.